Very good morning, friends. So I hope you're doing good and your preparation for the exams is also going good. Though the standard what we are talking is bad. Bad in the sense we're talking today in terms of impairment of assets. It's a wonderful standard. It's got a lot of practical relevance as well, an important standard from the examination point of view as well. Well, the first thing when I think in terms of impairment of assets, it always reminds me that there are two standards which deals with the concept of impairment. One is Ind AS 36, and there is another aspect of impairment which is dealt in Ind AS 109. Well, of course, our focus today is not on Ind AS 109. Our focus is on the impairment in terms of Ind AS 36. So what I'm going to do, let me, I think, put down the strategy, how we're going to go about. We've got a couple of questions which we're going to solve, but we're going to take quick revisions on the concepts. So first, I'm going to give you some mind maps, doing some quick revisions on the conceptual part of the standard. And then we're going to do questions as well, just to reinforce the concepts which are there in this particular standard. Now, I always tell people that, since it's a little technical standard, let's break it down into a step-by-step approach. And what I've done, I basically divided the standard into a total of 5 steps. So we are going to discuss each of these steps one by one as we proceed, and we'll do questions along with it. So I think let's begin the journey. So we are focusing on Ind AS 36. The name of the standard is called Impairment of Assets. The name of the standard is called Impairment of Assets. So at the first instance, let me just break it down into a 5-step model. Well, the standard does not give you a 5-step model. This is only for the ease of understanding that I've divided the standard into a 5-step category. So the step number 1. So as you proceed with this standard, the step number 1 would be, first of all, to see whether you are in the scope of the standard or not. Because as I just made a mention, that when you're looking at impairment, there are 2 standards on impairment. One is 36 and one is 109. And both of them deal with impairment, but of course, different kind of assets. So at the first instance, you need to see that you are in the scope of the given standard. The second step is, once you've seen that you are in the scope of the standard, the second one is to see that there are indicators of impairment. The second one is to see that there are indicators of impairment. Because unless and until there are indications of impairment, we are not going to trigger this standard. But you also know that there are certain exceptions where the indications need not be present. So we need to be very crystal clear that what are the indications and what are the kind of exceptions where the indications are not to be seen. We'll see that later. Now, once you say, yes, the indicators are present, then it is about computation. Then it is about computation of impairment loss. So it's not that you start calculating the impairment loss directly. It is only when there are presence indications which are present, and then you formally go to the computation of impairment loss in this particular case. Now, as you make your mind in terms of the computation, what should also immediately stick to your mind is that the computation of impairment loss could be computed either for an individual asset, or it could be for a group of assets, what we call CGU. That is a cash generating unit, because the company needs to consciously decide, is the impairment testing supposed to be done at the individual asset level, or is it supposed to be done at the group of assets? When I say group of assets, of course, it could mean with without liabilities. That is called CGU. So the first thing what we need to consider is the impairment in terms of, are we doing it for an individual asset? Is the impairment to be conducted for an individual asset, or it is to be conducted for a group of assets, which is technically called CGU, that is a cash generating unit. Now, let's also remind you in this particular case, when you conduct the impairment for a CGU, your mind should start getting connected in terms of goodwill. What is the treatment of goodwill as far as impairment is concerned? Because we know goodwill is never tested for impairment on a standalone basis. Goodwill is always allocated to the CGU and then the impairment testing is done. Another special issue which should also come to your mind is regarding the corporate assets. Because when you're doing the impairment testing for a corporate assets, that is also not individually tested. And that is also allocated to the CGU under review. So in this particular case, when you're looking at your mind mapping in terms of group of assets, what should come also is the special issue. So you should be able to map your mind that, okay, we need to consider how would you treat the goodwill in terms of impairment? How would you deal with the corporate assets in terms of impairment? I always believe it is important to first of all, map your mind in terms of the flow of the standard. Because there's so many issues which gets involved in the standard. And I think it's first of all important to see the flow in which you are going to map your thoughts in terms of the flow of the standard. So as we discuss the concept of a CGU, we need to take care of the two special agendas. How do you tackle the goodwill in terms of impairment testing? And how do you tackle the corporate assets in terms of impairment? Because neither goodwill is tested on a standalone basis, nor the corporate assets are tested on a standalone basis. They're always tested along with the CGU itself. Then comes the agenda number 4. So once you've taken the computation of impairment loss, there could also be reversal of impairment loss. There could also be reversal of impairment loss if the indicators have taken a U-turn. If the indicators have taken a U-turn, in this particular case, there will be a calculation of reversing the impairment losses which is computed earlier. And then finally, which is not very pertinent for our discussion, but just to complete the 5-step model, the disclosures which are applicable as far as impairment is concerned. So I think I've just given you, first of all, a basic foundation at the back of your mind. When you're looking at impairment under Index 36, your mind should flow in the level that, okay, first of all, am I within the scope of the standard? That's 1. Are there presence indications of impairment? That's 2. Because you would technically calculate impairment when there are indications. Number 3, the computation of the impairment loss with special references to the treatment of goodwill and the treatment of corporate assets. Number 4, if the indicators have taken a U-turn, how would the reversal of impairment loss be captured? And finally, the disclosures. So this is what I call my 5-step model in terms of impairment. I'm just trying to tune your thoughts in accordance with my things, maneuvering your minds early in the morning according to my thoughts. I know you must have definitely done all this, but I'm just trying to organize the things in the form of mind maps. Now, what we're going to do, we're going to first of all discuss step by step, make some conceptual mind maps on the standard, and then we'll also simultaneously keep doing questions. So no worry, we're going to first take a recap on the major concepts in that particular steps, and then we'll start doing questions also with you. Let's begin the journey. So far, so good, I guess. Okay, so I guess let's come back on the agenda. So I am coming to the step number 1. Now, as far as the step number 1 is concerned, that is considering the scope of the standard. And let's give you a very interesting chart at this particular stage. Since you've already now done the course, then I think it's more easy to connect all the dots and put this across. I always tell people, that it's a good exercise of looking at a balance sheet of a company and identifying that, okay, this asset is covered under 36, this asset is covered under 109, and maybe certain assets where there is an inbuilt impairment testing, where neither 36 nor 109 would apply. So when I look at the scope of the standard, my mind starts working on three different categories of assets from the balance sheet perspective. One are those assets where we apply 36, one are those assets where we apply 109, and one is those assets where neither 36 nor 109 is applicable, because the measurement principle of those standard indirectly takes care of, you can say, the impairment testing. For example, just to remind you, inventory. So what we're going to do, we're just going to make a quick mind map. So we're going to make a quick mind map in terms of this particular area. Though in terms of step number one, I don't see the possibility of, a larger question coming in, but I think there can be wonderful questions on MCQ, testing your conceptual clarity on the standard, that do you really know that which particular standard would trigger in this case. This kind of steps is definitely useful when you're attempting the MCQs in the exam. So as I said, I'll divide the balance sheet assets in three broad categories. So we can say one is those assets which are covered under Ind AS 36. One is those assets which are covered under Ind AS 109, and the other one is neither 36 nor 109. I call them as inbuilt impairment testing assets. There is an inbuilt impairment testing in those particular cases. Now, let's, I think, give you a little more deeper inputs as well. Now, when I look at these three categories, so the first thing is, number one, what comes to the mind, which particular assets are covered under Ind AS 36, and typically they're supposed to be non-financial assets. So typically, what assets are covered under this category is the non-financial assets. Impairment of all the non-financial assets like PPE, intangible assets, investment property, etc. They're all covered under Ind AS 36. But you also need to remember that there are certain exceptions. There are certain exceptions in the sense they're financial assets, because Ind AS 109 is typically covering those assets which are financial assets in nature. Now, since we're doing a revision, I guess I must definitely put across a few questions as well. So I think let me first put one question to you. Can you tell me an exception where a financial asset is covered under 36? The question is simple. That non-financial assets are covered under 36. Can you give me an example of a financial asset which is covered under 36? Let's get your inputs on that, friends. So we are looking at the exceptions where it is supposed to be a financial asset and it is still covered under the purview of Ind AS 36. And I'm given trades payable. Trades payable is supposed to be a liability. We're looking at impairment of assets. So don't say that it is trade debtors. No. Trade receivables is very much covered under 109. It's a financial asset. It is covered under 109 itself. Let me, I think, put my question again. I am looking at non-financial assets covered under 36. But I'm saying, is there a financial asset which is covered under 36? Because financial assets are covered under 109. So we're looking at those financial assets which are covered under 36. They're financial assets but covered under 36. Okay, I think let me give you the answer. Investments are of two types. One is related party and one is unrelated party. When you say investment in related parties, the focus is in terms of subsidiary, associate, joint ventures, and those investments are not covered under 109. Those investments are supposed to be covered under Ind AS 27, because all the investments in unrelated parties are covered under the financial instrument standard, that is 109. But all those related party investments, they're covered under 27. They've been scoped out of 109. When you make an investment in a related party, subsidiary, associate, JV, they're scoped out of the standard that is 109. And therefore, they are covered under 27, and in which case we measure those investments either at cost or a fair value. If a company measures those related party investments at cost, because of Ind AS 27, the impairment testing is covered under 36. I hope you got the inputs clear. So in this particular case, we can say the exception is investment in a related party, investment in a related party at cost. If you've got investment in related party at cost. So I think just to give you the reference, that this is scoped out. It is scoped out of Ind AS 109. Ind AS 109 does not cover equity investments in related party. So since the equity investments in related party is not covered under the purview of 109, and you would consider Ind AS 27, I put it again, you're going to cover Ind AS 27. So investment in related parties, this is going to be covered under Ind AS 36. That can be a very interesting point of putting questions in terms of MCQ. Investment in a subsidiary, associate, JV is covered by impairment under which standard? Ind AS 27, Ind AS 36, Ind AS 109, or not applicable. Wow. Then you know that investments in related party is going to be covered under 36. Great. Now let's go further. On the same footing, since we're talking of 109 as well, financial assets are covered under 109. There is an interesting exception here as well. That means we've got certain non-financial assets and they are covered under 109. So can you think of an example and give me which is the non-financial asset which is covered under 109? 109 per se covers financial asset, but we're looking at an exception which is non-financial but is covered under the ambit of 109. Okay, so I get the answer 36. No. I mean that there is a non-financial asset which is covered under 109 impairment. Loan on demand, no. There is no concept of putting that loan on demand in terms of this standard. Loan on demand is in any case a financial asset, and that would in any case get covered under 109. We're looking at non-financial covered under 109 because non-financial are covered under 36. Okay, I think let me answer that question as well. So there is what we call contract asset. There is what we call contract asset which arises on account of Ind AS 115. When you apply the revenue standard, there is Ind AS 115. In those cases, a contract asset would arise. And that's not a financial asset because a contract asset does not represent a contractual right to receive. Therefore, it's a non-financial asset, but its impairment is covered under 109. I think, let me just quickly connect the dots. So your mind should be very clear. Financial assets 109, exception contract asset, non-financial, but still covered under 109. Next, non-financial is under 36, but there is an exception where the financial asset is covered under 36. Investment in related parties which are measured at cost, they're covered under 36. I hope, friends, I'm very well connected on my thoughts. Now, let's come to the concept of inbuilt. Now, here we are looking at, the distinction, the line distinction is not important. I'm just giving you the list of those assets which have got an inbuilt impairment. Neither 36 applies, nor the case of 109 applies. So one of them is, of course, inventory. Inventory as per Ind AS 2. Inventory as per Ind AS 2 has got an inbuilt impairment testing. Inventories are taken at cost or NRV, whichever is less. And therefore, there is an inbuilt impairment testing in the measurement principle of that asset itself. The second one is what we can say is supposed to be biological assets other than bearer plant. Biological assets which is other than a bearer plant. Because we know that a bearer plant is covered under Ind AS 16. And Ind AS 16, of course, covers the concept of impairment. So we're looking at other than bearer plant, which is covered under Ind AS 41. The reason in this case is that biological assets are taken at a net fair value. They're captured at a fair value less the cost to sell. Since they are captured at a fair value less cost to sell, the concept of impairment testing is not applicable. Then there are more examples, number 3, and that is called DTA, deferred tax asset, which is covered under the purview of Ind AS 12. Ind AS 12 has got its own concept of prudence, because when there is a DTA in your balance sheet, you always make an annual review of the concept of prudence, that is there a certainty that future taxable income would rise. Whenever the company makes an assessment that future taxable income would not arise, in those particular cases, the DTA is simply, taken a review under Ind AS 12. So no impairment testing for a DTA is required. Ind AS 12 indirectly takes care of the inbuilt impairment. Number 4, we've got what is called plan assets, and that is under Ind AS 19. Because they are also captured at a fair value as per Ind AS 19. And since they're captured as per Ind AS 19 at a fair value, no impairment testing is required. And then there is another one as well, and that is non-current assets held for sale. And that is as per Ind AS 105. NCA, which is held for sale, is again captured in the balance sheet at fair value less cost to sell. Because at every balance sheet date, the NCA, though it's going to be sold within 1 year, but on the balance sheet date as per 105, it is captured at the fair value less cost to sell. So these assets do not need any impairment testing. So they've got inbuilt impairment testing in this case. So I think we've come to the 5 areas where neither 36 nor 109 is applicable. And I think it's important also to tell you something more, and which I will just, maybe shortly expand. Let me, ask a small little question, before we just connect the dots. If a company has taken a PPE or an intangible assets, let's say at a fair value, at a revaluation model, is impairment testing going to be applicable? Because you've got a cost model, you've got a revaluation model of considering a PPE and intangible asset. So if the company considers a revaluation model under 16, that is PPE, and 38, is it covered under the purview of 36? So what do you say, friends? If you've got property, plant, equipment, you've got intangible assets taken at a revaluation model, are we covered under the impairment aspects under Ind AS 36? And that's rightly said, yes, of course. So I think it's important to also put it across that if you've got a PPE or if you've got intangible assets at revaluation model, so even if they're taken at a revaluation model, so you need to be clear on this, that yes, Ind AS 36 applies. Ind AS 36 is still applicable. Many people think it's not going to be applicable, but yes, it is applicable. My step number 1 is done. My thought tells me that this step could be useful only for the MCQ point of view, not from the larger questions point of view. Now let's, quickly take a recap in terms of things. I'm sure, I'm getting a feeling that I've done already some value additions, though we're doing impairment, which is, reducing the values. But I think I must have definitely improved the values so far. Say yes. That's great. So I think I've given you the inputs on this. Now let's go further. So in my step number 1, what I've given you as a mind map, just to, connect the dots at the back of your mind. You need to be crystal clear that first of all, when you look at assets from impairment perspective, your mind should work on 3 kind of assets. If you say it's a non-financial asset, 36, but then there is a financial asset which is covered under 36. Investment in related party, which is subsidiary SVGVs carried at cost. Second is that if you've got financial assets 109, but there is a non-financial asset which is covered under 109, contract asset arising out of the revenue standard 115. And then you can say a list of 5 things on your hand, 5 fingers, so 5 things on the hand, where neither 36 nor 109 applies. You got the case of non-current assets held for sale. You got biological assets other than bearer plant. You got a plant assets. You've got a DTA and you've got inventory. And also remember PPE, intangible assets, which are taken in a revaluation model, is still covered under Index 36. Good. So I think this is the step 1 mind mapping. And now let's go on to the step number 2. Now let's go on to the step number 2. Now, in terms of the step number 2, as I said, what you need to consider is the indications of impairment. Because Index 36 is supposed to be, based on triggering conditions, that there are indications which tells me that there could be impairment. And that's where the focus is, indicators of impairment. Indicators of impairment. So we've got the second focus step, making a mind map, indications of impairment. But as we discuss the indications of impairment, immediately what should come to the mind is, are there any exceptions? That can also be a very good area in terms of testing in the MCQs, that, okay, which cases we don't need any things. So I think let's first of all talk about the exceptions. So let's first of all talk about the exceptions where the indications of impairment are not required. I think let's start asking you that. So tell me, what are the exceptions where impairment indications are not required to conduct an impairment testing? So how many exceptions do we have? In which particular case impairment testing will be conducted on a mandatory basis every year, irrespective indications are present or not? Okay, abnormal situation, no. Why we're talking of abnormal situations? Intangible assets with an infinite life. That's wonderful indeed. And I think one of the most important intangible asset, which invariably, we see in the balance sheets, and that also gets tested for impairment without fail because it is not amortized. And that's right, the purchase goodwill arising on account of 103. Wonderful indeed. So I would also add to the list intangible assets under development arising out of Index 38. That's great. So in terms of exceptions, we can say no indications required. No indications are required. So we can say this is going to be a mandatory impairment testing. It's going to be a mandatory impairment testing every year. It's going to be a mandatory impairment testing every year. So we've got a total of, I would say, 3 exceptions in this case. So I will put it across as 3 exceptions. The first one we can say is goodwill. Goodwill is one which is, of course, we're talking about purchase goodwill. Goodwill under Index is not amortized, but is annually tested for impairment every year. So this is, of course, the purchase goodwill, as you rightly said, arising out of 109. And then the second is supposed to be intangible assets with indefinite, not infinite, with indefinite life. Because assets which cannot be, we cannot attribute a life. Because if you got assets where you cannot attribute a definite life, it's not infinity. It's not infinity. It is supposed to be indefinite life in nature. So assets which have got an indefinite life, they are also going to be tested every year. And I'll also put it as intangible assets under development phase, R&D, So they are under the development phase of R&D. So these assets require a mandatory impairment testing. Practically, you can see the exception list is all about the intangible assets. So whether it is goodwill, whether it is intangible assets with an indefinite life, or it is intangible assets under development phase, they are annually tested for impairment. No indications required. Okay, now I think let's also give you the insights on the indications of impairment. Now, when we start looking at the indications of impairment, I would say there are two indicators. One is external and one is internal. I think I'll not get into the internal indicators because that is something which is, within the organization itself, but we're looking at the indications in the external environment. So in terms of the indicator, let's, I think, look at the external indicators. And would you like to tell me how many external indicators are there in terms of the impairment? What is the total number of list in terms of the exceptions on that? I think I'm getting the number 3, is it? Okay, that was 3 exceptions, I guess. How many are the external indicators? I think I've already drawn the chart and you can decide on the number. Right, I'm getting quickly one by one on them. That's great. So there are total 4 external indicators which will tell me that there could be a possibility of impairment. That's rightly said. So the first one is, we can say, significant. I'm just putting the keywords. One is that there is a significant decrease in market value. There is a significant decrease in terms of market value of the asset. If we see that there is a significant decline in the market value of the asset, it is indirectly a reduction in terms of fair value less the cost of disposal, or you call it as fair value less the cost to sell. So in this case, significant decline in market value is one. Then we can say that there are adverse changes. There are adverse changes in business environment. I'm using the word business environment, though the standard does not use the word business environment. It talks about the changes in different kinds of environment, as you rightly said. There could be changes in terms of technological environment, maybe in terms of economic and political environment. I would say as a whole, we're looking at the business environment, but otherwise it is supposed to be technological. It could be a technological environment, it could be a legal environment, etc. So any adverse changes in the business environment in which the entity's asset is dedicated. So in this particular case, what we're indirectly looking at the impact on the cash flow. Because if there are adverse changes which are taking place in the business environment, they will have direct impact on the cash flows, and those direct impact on the cash flows will mean a reduction in terms of VIU. The next is, there is increase in interest rates. The next is that there is increase in the interest rates in the economy. Now, since we apply the concept of present value factor, naturally, you know this on a mathematical level, higher the discounting rate, lower is the present value. So when you're looking in terms of the increase in interest rate, the discount rate goes up. When the discount rate goes up, the present value automatically comes down. So increasing interest rates could be another thing. And there is another 4th clause as well. The net assets of the company is greater as compared to market capitalization. The net assets of the company is greater as compared to the market capitalization of the company. The balance sheet shows the net assets of the company is much larger as compared to the market capitalization, number of shares into the market price per share, and that would also be indicative that there can be impairment. Let me, I think, ask you a quick question further. Is this indicators an illustrative list, or is it exhaustive list of condition? Is the standard given the list is exhaustive, or is it illustrative in nature? Am I supposed to think beyond the list given in the standard, or is this something which is exhaustive in nature? What do you say? So let's get the inputs on your side. The list which is given in the standard, is this illustrative or is this exhaustive in nature? And that's absolutely correct. The list is supposed to be completely illustrative. This is not exhaustive in nature. Good. So this is not exhaustive in nature. This is supposed to be completely illustrative in nature. Okay, so far so good. So I think we're done with the two steps. The fifth step, it's as it is disclosure, not to connect it. So I think we're done out of 5 steps, 3 steps already. Oh my God. But these are the easier steps in terms of the standard. Looking at, first of all, that are we within the scope of the standard? That's one. And the second is looking at the inputs in terms of indications of impairment, an illustrative list which is given in the standard, and the list of exceptions where the impairment testing is done on a mandatory basis year by year. Wow. Now I think comes the main journey, that is step number 3. Let's go to the next one. So there's no question to be done on this particular part, because I think this is an easier part, just connecting the introduction to the standard. Now comes the crucial part, and that is the step number 3, and which is on the computation of impairment loss. And that is on the computation of the impairment loss. Now, as soon as you look at the step number 3, my mind tells me that how I'm going to, create a map in my mind. The first agenda is you need to decide impairment testing is done for an individual asset or impairment testing is to be done for a group of asset. So you need to decide what are the parameters with the help of which you decide that impairment testing is done at what level. So I think the issues which should come to your mind, the list of issues which should come to your mind, just making a quick mind map on this. So the list of issues which should come to the mind is, number 1, how to decide. The first agenda is how to decide that impairment, how to decide that impairment testing, how to decide that impairment testing will be done, impairment testing will be done at what level. So the first agenda to decide is the impairment testing is going to be done at what level. So what level means individual or a group of assets. So you need to decide, is the impairment testing to be done at an individual level, or is it to be done at a group level, that is a CGU? So there are parameters which you should be clear in your mind that, okay, these are the parameters to be applied in this case. You want me to run those parameters as well? You can say a no, or if you want, I can give you that as well. So you want me to make a run on the parameters in terms of how do you decide impairment is done individual or group? Yes. Okay, nobody will give you that as well. The second is the special issues. The second is the special issues which will crop up, and that is with reference to CGU. If you're doing an impairment testing in terms of a CGU, you need to consider how will you treat goodwill and how will you treat the corporate assets. So how will you treat the goodwill and the corporate assets? So our focus in terms of this is the entire step is going to be look at the accounting, is going to look at the complete level of accounting. We want to see how the accounting of the impairment loss, the computation and the accounting, I would say. So I would say the focus is in terms of both the computation and the accounting treatment which will follow. So I'm going to give you some nice mind maps today as well, so that you're able to revise the concept as well. This is the step where we're going to do questions also with you. No worries. Okay, So I think these are the two issues which should come to your mind. That in the third step, once you say that yes, we are in the scope and we are saying that there are indications of impairment, how do you decide impairment is done at what levels? And then we'll see the accounting for the individual, the computation and the accounting for individual assets. And we're also going to look at the computation and accounting for a CGU with special reference to goodwill as well as with reference to the corporate assets. So we'll subdivide our discussions into various components. So let's do one thing. Let's now go one by one. So we are taking issue number one. I'll make a list of issues in step number 3 and we'll keep concentrating on those issues one by one. So the first issue which is coming to the mind is how to decide. The first question is how to decide that impairment testing will be done at an individual level, or is it to be done at a cash generating unit level? How do you decide that? You know, I have actually created another 3-step model in terms of this parameter as well. I always tell people that, if you want to decide the impairment testing is done at what levels, you need to decide, number one, you need to put 3 questions to yourself. So the first is the individual asset generating cash flows largely independently? Mind the words. Is the individual asset generating cash flows largely independently? If you say yes, you need to go to the step 3. If you say yes, you cannot decide that impairment testing will be done at the individual level. No. This is the one of the biggest misconceptions people get, that when you do impairment testing, they believe that if the asset is generating cash flows largely independently, it does not mean that impairment testing will be done on an individual asset level. I'll go to step number 3. But if you say no, it's not generating, then you go to the step number 2. And in step number 2, you evaluate that is it capable of generating. So in the first step, we are evaluating, is it generating? And in the second step, we are saying that is it capable of generating cash flow? If you say it is capable of generating, you could still go to step 3. And if you say it's not capable of generating, then it is a part of CGU. Don't worry, let me just document that part. So I'll just take an example also. So we're just creating a small little mind map on this case as well. So we're going to apply a simple 3-step model on this case. Number 1, is the asset generating cash flows largely independently? Is the asset generating cash flows largely independently? When I say generating, means it is actually generating. So if you say yes in this particular case, yes, it is generating. Or you say no, it is not generating. If you say yes, it is generating, in that particular case, you need to go to step 3. Do not conclude at this stage that if it is generating, then I am going to, do the impairment testing at an individual level. No, 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 no. And if you say no, then we go to the step number 2. And then we come to the step number 2 and we say, is the asset capable of generating? You can see the words carefully in terms of the step number 1 and 2. Look at the difference in terms of 1 and 2. Here we are saying, is it generating? And here we are saying it is capable of generating. Generate kar raha hai, generate kar sakta hai. So there are 2 things. Is it generating actually? Is it capable of generating kar sakta hai? So is it capable of generating cash flows largely independently? The words are very clear, largely independently, largely independently. So we need to see that is it capable of generating cash flow largely independently. So here again, the answer would be a yes or a no. So if you say yes, we still go to the step number 3. And if you say no, then we have decided it is a part of the CGU. In this case, it is a part of the CGU. It is neither generating nor capable of generating. That means it has to be tested along with something else because it's neither generating nor capable. Therefore, it goes on a part of CGU. And then comes the step number 3. It is generating, step 3. It is capable of generating, step 3. And it all depends upon the management perception. It all depends upon the management perception of a profit center. So I always tell people that it all depends upon the management perception of the profit center. How does the management look at the evaluation of the asset as a profit center? The asset is generating cash flows independently or is capable of generating, but I don't view that as a profit center. So I'll do the impairment testing as a part of CGU. I think let's take a quick example to take a revision of this concept. But just keep the things in mind. Is it generating? Is it capable of generating? And then the management perception. If you're generating, management perception. If you're capable of generating, management perception. If you're not generating, you're not capable of generating, then of course you cannot be tested alone. Then it is a part of the CGU. I think let's take a quick example on this. Let's say we're looking at, let's say, two examples. Let's take two examples quickly to decide the agenda. And these examples are given in the standard as well. So let's take example 1 and let's take example 2. I'll give you quick examples. You apply and tell me impairment testing at what levels. Let's say there is a division A and let's say there is a division B. Division A is making a sale of 80% output. It is making a sale of 80% output to division B. It is making a 80% sale of output to division B. And you can say the remaining 20% is being sold to outsiders. Now, quick questions at your end. Is division A generating cash flows largely independently? I'm looking at division A. I'm looking at division A. So is division A generating cash flows largely independently? And that's right, no. In this particular case, 80% of the output is sold to division B. It is not generating cash flows largely independently. So in this particular case, my step number 1 is it is not. Okay, if I give you the data now, if I give you the data that this has got no external market, let's say this has got no external market. So if he does not give it to B, if he does not give it to B, he cannot sell it in the outside market. Let's put the second question to you. Is A capable of generating cash flow largely independently? It is not generating, but do you think it can generate as well? And that's rightly said, no, because he does not have got an external market and therefore it's not even capable. Na kar raha hai, na kar sakta hai. So in this particular case, can I say the impairment testing will be done as a part of the CGU itself? No need to go to the step number 3. Now, if I twist the example with a certain inputs, let us say I say that yes, he's got an external market. Let's assume the other case. So this is the one where we're saying no external market. Now let's say if I say yes, there is external market. Let's assume the other way around. Let's say there is an external market. So in the step number 1, you would say a no. Now tell me in step 2. Now tell me in terms of step 2, if A can sell things to the outside, if he doesn't give it to B, is A capable of generating cash flows largely independently? Yes. So in this case, what we do, we go to the step number 3 and we decide the management perception. Does the management consider division A to be a profit center? If yes, I will evaluate the impairment for A separately. If the management believes A is not a profit center to me, we collectively look at A and B as one. Then in that particular case, impairment testing is done in CGU. Great. Let's take another example in this case. Let's say a school appoints, let's say, a transport agency. That's also given in the standard. Let's say a school appoints a transport agency and they are using 10 buses. And this is for 10 different routes. The transport agency takes a contract from the school authorities, 10 buses operating on 10 different routes. When the school authorities gave this contract to the agency, they told him that there will be 9 routes. They told him that there will be 9 routes giving a profit. And they said that there will be a 1 route which is going to give you a loss. But the agency still accepted the contract. So they told him very clearly that you're going to get 10 routes, out of which 9 routes you're going to get a profit and 1 route you're going to get a loss. But the agency still accepted the contract. Now let me ask you, is each route generating cash flow largely independently? Think. Is each route generating cash flow largely independently? And you said, no. I would say the answer is a yes. It is generating cash flows largely independently. The children operating on different routes belong to different places in the city. So there is no overlapping in terms of students. So it is definitely generating cash flow largely independently. Then I go to the step number 3 and I look at the management perception. Tell me, what is the management perception? Are they considering all the routes as one profit center? Are they considering each route as a different profit center? When they accepted the contract at the inception, what was their feeling? And that's right, as all of them will be taken as one. Great. So it will be taken as a CGU. Wow. I think so far so good. I think since we're almost like done with the 2 steps so far, I think the 3rd step is going on. Let's get your comfort zones at this stage. Nothing technical. We just did the scope of the standard, got the dots connected. The indications are done. And in step number 3, the issue number 1 is done. And that is taking a call and deciding that is the impairment testing done for individual or for a group of assets. So let's get your comfort zones on a scale of 10 at this stage. I think it should be a 10 out of 10. Wonderful indeed. I got the answers 10 out of 10, 9 out of 10 on the safe side. Great. Okay, now let's come to the second issue with you. So we're on step number 3. Now we are on the issue number 2. So this is now my issue number 2 from where the practical aspects would start. So in issue number 2, we are going to talk in terms of individual assets, computation accounting. In issue number 3, we're going to talk of CGU, computation accounting, with the aspect of goodwill, and then the issue number 4. So how you're going to map your minds as well is very simple. So you're going to consider number 1. Okay, in the step number 3, I'm focusing on the step number 3. You need to focus on how to decide impairment for individual or group, issue 1. Then you come to the second agenda, individual asset computation accounting. Agenda number 3, computation accounting CGU with goodwill. And then with the corporate assets. So you've got 4 agendas with which you can pen your thoughts. So my issue number 2 is the computation. And accounting for impairment loss in terms of individual asset. So the focus is right now on the individual asset. So we're looking at the computation and the accounting of impairment loss for an individual asset. So let's make a quick mind map on this as well. So let's, I think, divide our mind map in terms of two parts. One is the computation, which is simple and straight, and the other one is the accounting treatment. So let's make a mind map on this lines. Then we'll do some questions on this area. So I am looking at number one, computation. I'm looking at number one, that is computation. And I'm looking at the second aspect, and that is the accounting treatment. Okay, so let's, I think, put this down. Can I say, as far as the computation is concerned, it is simply, can I say it is simply impairment loss is the carrying amount minus the recoverable amount. It cannot be the other way around. Can I say it is only if the carrying amount is greater as compared to the recoverable amount, you are going to get an impairment loss. And when you see the concept of recoverable amount is supposed to be what? Higher of the two? It is higher of the two. And what is the higher of the two? Can I say one is supposed to be VIU, that is supposed to be the value in use, and the other one is supposed to be fair value less the cost of disposal, or you want to call it as fair value less the cost to sell, either of them. So call it as a fair value less the cost of disposal, or you can say the fair value less the cost to sell and the VIU. Now, more things coming to the mind. When you say it is a VIU, it is the present value of future cash flows. It is the present value of the future cash flows arising from continuous use, arising from the continuous use and its sale. So we're looking at the cash flows arising on account of two factors. One is the cash flows arising from the continuous use of the asset, and generally it is for a period of 5 years, the projected approved, you can say the projected approved forecast of cash flows, and also from the ultimate terminal value, the sale of the asset. So you take the present value, and for this purpose, the discount rates is already given. And fair value less cost to sell doesn't need an explanation. So the computation of impairment loss is pretty simple and straight, comparing the carrying amount versus a recoverable amount. Recoverable amount is the greater of the two values. I have a small little question now coming to my mind at this stage. This could be a good MCQ as well. If the VIU or a fair value less cost to sell, anyone exceeds the carrying amount, can I outrightly say there can be no impairment? I put it again. If your VIU or fair value less cost to sell, you compute any one and it's greater as compared to the carrying amount, can I say there is no need to compute the other one? There is no impairment. Is that correct? The moment you are considering that the calculation of the recoverable amount, either the fair value less cost to sell, or you can say the VIU, any one of the two elements computed is more than the carrying amount, there cannot be any impairment. There is no need to calculate the second element. And that's right. So I think in this case, let's put a note across. If carrying amount is, or rather not carrying amount, if the fair value less cost to sell or VIU, any one is more than carrying amount, there can be no impairment. There can be no impairment loss in this case. So we can say there is no need to compute the other element. There is no need to compute the other element in that case. You calculate one of the variables, you calculate just one of the variables, and it is more than the carrying amount, we are safe. If one of the elements is more than the carrying amount, we are safe, then there cannot be any impairment loss. So in a given question, any one variable is computed and it's more than the carrying amount, we are pretty safe. There is no impairment loss. Okay. Now let's come to the accounting treatment in this case. So now let's make an accounting treatment chart as well. So let's consider the accounting treatment in this case. So when you consider the accounting treatment, I would say either it is a case of a non-revalued asset, or it is a case of a revalued asset. So immediately when your mind starts thinking on the accounting treatment, you should start thinking, okay, this is a case of a revalued or a non-revalued asset. So would you like to tell me, if it is non-revalued asset, where do you put the impairment loss? And I know as there's another small thing which is coming to the mind, which I'll ask you. So can I say if it is a case of a cost model, a non-revalued asset, then where are you going to put that? Can I say this is going to be debited at which place? Profit and loss. And that's right, it goes in the P&L. And if it is a revalued asset, can I say I will debit the other comprehensive income to the extent balance is available, So we will first of all consider this to be a debit to the OCI. So you can say that if there is a balance in other comprehensive income, we'll debit that, and then we will debit profit and loss for excess, if any. So if there is any further impairment loss, then you will debit the P&L. Can I say an impairment loss for a revalued asset? Mind the words. Can I say the impairment loss for a revalued asset is to be treated as a downward revaluation under Ind AS 16? Will that be a correct statement to say? That when you're considering the impairment loss for a revalued asset, treat it as if it is a subsequent devaluation under Ind AS 16. Is that thought correct? That in short, if I want to condense it and put it like this, that's right. So we can say indirectly in this particular case, impairment loss is treated as subsequent devaluation. It is treated as a subsequent devaluation as per Ind AS 16. So we can say the way you treat a subsequent devaluation under 16, we can say this is exactly a subsequent devaluation. By the way, a small little question further. When you go to book the impairment loss, what will be the implications under Ind AS 12? Will it lead to a DTA or will it lead to a DTL? I'm sure you can make a walkthrough that once you consider impairment loss, the carrying amount of the asset is going to go down. But as far as the tax base is concerned, they will not give you any deduction at that stage. The deduction will remain equal to the cost of the asset later. So DDA or a DDL. So give me the inputs on this. Let's put a box out here. So impairment loss will result in what? Is it going to result in a DTA or a DDL? That's correct. So we can say, if you look at the implications in terms of Ind AS 12, we can say this will be considered, we can say it'll lead to a deferred tax asset. The impairment loss under this standard will lead to a creation of a DDA. Wow. I think it's time now to do some questions. We've been, doing some mind mappings of the concept. Time to do some questions on this area now, on the individual asset. So let's, I think, take it further. So pretty simple and straightforward question. Let me first share the normal question to you. I hope the question is clearly visible. Let's, I think, read the question and let's decide the treatment. It says on 31st December X1, entity noticed that one of the items of plant and machinery is often left idle. On this date, the carrying amount is supposed to be 5 lakh. The book value or the carrying amount is 5 lakh and the fair value is 325. And the estimated cost to dispose of the asset is 25. If the asset is not sold, the entity estimates it will generate cash inflows of 2 lakhs in each of the next 2 years. Assume that the cash flows occurs at the end of each year and the discount rate is given 10%. Pretty simple and straight. So when it says it is one of the items, it is clear-cut indication that impairment asset is taking place for an individual asset in this particular case. Discuss the accounting treatment of the above in the financial statements for the year ending December X1. How would your answer to part A be different if there is a balance of 10,000 in other components of equity, which is relating to the prior revaluation of this particular asset? So which means it relates to a revalued asset in this case. I think let's do the computation. So I think at the first instance, what we need to do, we need to calculate the recoverable amount, which is supposed to be the higher of the two. One is, we can say, the fair value less the cost to sell. So let's see what is the fair value less the cost to sell. The fair value is 325 and the cost to sell is 25. So can I say the fair value less cost to sell is supposed to be 3 lakhs? That's right. And then it says that we're going to generate inflows of 2 lakhs for the next year. So let's calculate the VIU. So let's take the present value of this 2 lakhs at 10% discounting rate. So 10% discounting rate, this is 1.736. So the present value of this, that is 347,200. So we can say the recoverable amount is supposed to be the greater of the two. So 3 lakhs or 347,200, whichever is greater, that becomes a recoverable amount. And if you look at the carrying amount of the asset is 5 lakh. So we're going to get the impairment loss. So let's see what is the impairment loss. I guess that's right, 347,200. So the impairment loss is 152,800. So I think let's now put a very simple and a straightforward question in this case. So in this part number A, what is the accounting treatment? Can I say this is going to be debited to the profit and loss? This entire 152,800 is going to be debited to the P&L in this case. Simple and straight. And can I say in the second case, when you've got 10,000 in the other components, so how much are you going to debit the OCI? How much will be debited in the OCI? Can I say to the extent of 10,000? Whatever is there will be debited to the OCI and the remaining is going to be debited to the profit and loss. That is 142,800 that will be debited to the P&L. As simple and as straight indeed. Superb. This was just to give you a warm-up exercise in terms of impairment, accounting treatment for an individual asset. Okay, that's great. Now let's go to the next one. Okay, this is on the CGU. I'm yet to discuss the CGU with you. So we'll come to the CGU. This is again on a CGU. And this is on goodwill. So I think I've just taken that one questions. Rest is on CGU, goodwills, etc. Okay, so I think let's now come back on the agenda. So my issue number 2 is done. I now need to go to the issue number 3. So this was individual asset. Now comes the real part, and that is the individual, the group of assets CGU. Let's go to the next agenda. So we have now got the issue number 3, and that is the computation. That is the computation and accounting. It is computation and accounting. This is for a cash generating units. and we're talking inclusive of the goodwill. So when you're going to do this, including, this will be including the goodwill impact as well. Okay, now comes the real inputs coming in. Just let's connect the dots. My mind is now working on the computation as well as on the accounting. So I'm going to say a few things. Just vouch me. We're going to make a small mind map on this. I'm just trying to, map the entire things in a mind in a very chronological order. At the end, you should be able to get the complete thoughts. Scope is in terms of step one, which standard applicable to which assets, indicators with the exceptions, and then you come to the computation. Issue one is how to decide individual or group. The second issue is individual asset. The third is the CGU. The fourth is the corporate asset. And then comes the fourth step, that is reversal. Reversal, individual, reversal, group of assets, done. It's not a very complicated standard if you think chronologically. Okay, now just making a mind map on the computation and on the accounting treatment. So we are looking at the computation. We're looking at the computation and we're looking at the accounting. Now let me say something, you can vouch me. Then we'll do some extensive discussion on goodwill as well. Can I say in terms of computation, you will compare the book value of CGU plus the allocated goodwill and then compare it with the recoverable amount of the CGU. Is my thought correct? So I am going to compare, you can say, the book value of the CGU plus the allocated goodwill and then compare this with the recoverable amount of the CGU. So you need the effective book value of the CGU. I call it as effective book value. So when you consider the book value of the CGU with the allocated goodwill, you get the effective book value compared to the recoverable amount of CGU. Is my thoughts correct? So I'm looking at the computation. So we can say in terms of the computation, I will take the book value of CGU plus the allocated goodwill plus the allocated goodwill. The sum total of this is going to be compared with the recoverable amount of CGU. That is how the impairment loss is going to be computed in terms of a CGU. That's right. You take the book value of the cash generating unit and you add the allocated goodwill. Can you tell me what is the ratio in which the goodwill is supposed to be allocated to the CGUs under review? Though, of course, we are always given the ratio in which it is allocation, but technically, what is the basis? How do you allocate the ratio? What is the ratio in which the goodwill stands allocated? No, first to goodwill, that is accounting treatment. That I think you're talking about the accounting treatment. No. That is the allocation. The accounting is going to consider how the impairment loss is going to be allocated to the CGU under review. So this accounting, we're going to discuss the allocation of impairment loss. My question right now is when you are going to decide the allocation of goodwill, let's say you've got 3 cash generating units. So what is the ratio in which the goodwill is going to be allocated to the CGUs under review? Ratio of synergic benefits. So I think let's put it out here. This will be in the ratio of synergic benefits. So this is the ratio which will be given in the question. So we allocate this in the ratio of synergic benefits. The allocation of goodwill to the CGUs under review is going to be done in the ratio of synergic benefits. Okay, so once we get the impairment loss, now the question rises, how would you allocate this impairment loss? I slightly differ in terms of what you said. Many people say that I'm going to first of all decrease the goodwill. I always say no. You should first look at the instructions in the question. Because sometimes there may be certain data which tells you clearly that management has already decided that these are certain assets which need to be impaired. So I would say the allocation of impairment loss should be done in 3 parts. First, you look at the instructions in the question. which asset the examiner is telling you to decrease and which not to decrease. Consciously look at those assets which needs to be reduced and which need not be reduced. Then I would say you should come to the goodwill decrease, and then I would say to the other assets in the book value ratio. So I would say the priority number one is that we will first of all look at the instructions in the question. So we will first of all look at the instructions in the question. The second is we'll decrease the allocated goodwill. And the third is you can say other assets in CGU. And this will be in the ratio of book value. So we will do this in the ratio of the book value. This is how the allocations will be done. So first we need to allocate the goodwill to the CGU. Yes, based on the instructions we need to work. Absolutely. So I think my priority will be to first look into the instructions in the question. I'll decrease those assets where the examiner instructs me. Then I'll decrease my goodwill and then the other one. Now, let me, I think, tell you and remind you at this stage when you are considering the allocated goodwill, we'll discuss this in detail very shortly. This allocated goodwill, can I say, we need to be careful. So in this particular case, we need to be careful that is it supposed to be a full goodwill or is it supposed to be a partial goodwill? We'll discuss that very shortly. We'll discuss this very shortly. Right now, let's not complicate this. Let's only look at the normal treatment. Then we'll see that when you're considering this goodwill, we need to be careful, because if it is full goodwill, it can be added as it is. But if it is partial goodwill, it needs a grossing up. So in terms of partial goodwill, we need to gross up. We'll see those illustrations as well. So this is one thing which we need to be careful on, that when you're considering the calculation of the impairment loss and when you consider the allocated goodwill, you need to be careful. If the NCI is at a fair value, in those particular cases, the goodwill is full, you can take it directly. If the NCI is at a PASNA, then in that case, there is a need to gross up the goodwill and then take care. So we'll discuss this special issue very shortly and create a mind mapping. Let's now come to a question on this area. Let's, I think, look at a question on this area, which is on a CGU. So let's have a look at a question on a cash generating units. I've taken a few different questions as well. I have some examinations, RTP questions, but I thought, let's take some different questions also. The revision gets a little better. Okay, it says there is an explosion in the factory. Impairment indication. The carrying amount of the assets is given to me. So the carrying amount of the assets is given to me in this case. So I am given the carrying amount of the goodwill, patents, machine, computers, etc. So goodwill is already a part of the CGU. The factory operates as a CGU. So the factory is operating as a CGU. An impairment review reveals that there is a net selling price of 1.2 million that is supposed to be the fair value less the cost to sell. And then it says the value in use is 1.95 million. It says half of the machine is blown to pieces and the other half can be sold. It says at least at the book value. So 50% is blown to pieces and 50% can be sold at the book value. The patents have superseded and are now considered worthless. Discuss with calculations how the impairment loss will be accounted for. So we'll first calculate the impairment loss and then we will allocate the impairment loss as well. Let's do this. So I think at the first instance, or let me just use the dark color only. So at the first instance, what we can do, we can calculate the impairment loss. So we can calculate the carrying amount inclusive of the goodwill. So let's take the carrying amount inclusive of the goodwill. So 2,600 is the carrying amount including goodwill. Compare this with the recoverable amount. The figures are in thousands. So your fair value less cost to sell is 1.2 million. The VIU is 1.95 million. So whichever is greater. So 1.95 million in terms of thousands. That's going to be 1950. So we can get the impairment loss in this case, and that works out at 650. That's, I think, simple and straight. Yes, the value in use is the figure of recoverable amount. So you compare the carrying amount with allocated goodwill versus this, we get the impairment loss. Now you tell me, what do I decrease first? Now tell me, what do I decrease first? He's given me half of the machine is blown to pieces. Patents are considered worthless. So can I say, if I look at the instructions in the question, there is a need to reduce the machine by 50%. There is a need to reduce the patents by 100%. And that's right. So in this case, we will first decrease the machine. Then we will decrease the patents. So let's say the machine will be decreased by 50%. So 50% of the machine would mean 150. Patents have become useless. That is 200. Now tell me, after the machine and patents, what next? We've listened to the instructions in the question. 50% machine stands reduced. The amount of patents is worthless, stands reduced. Next what? And that's right. The next is goodwill. So we decrease the goodwill to the extent of 100. So this has gone down. This has gone down. Let's see what is the balance. So out of 650, 150 machine is gone, 200 patents is gone, 100 goodwill is gone. Then we can say we need to decrease. We need to decrease the other assets by the remaining 200. Now let's see which other assets. Goodwill is already done. Patents is already done. Machine is already done. Can I say it's going to be computers and building in the book value ratio? Parents, why is it reduced? It says parents have superseded and are now considered worthless. So parent gets reduced on account of that. So we're going to decrease this computers and the building. So we'll decrease the computer and the building in this case. And this decrease is going to be in the ratio which is 1:3. So divide this in the ratio 1:3. So that would be computers decrease by 50, building decrease by 150. And based on this, you will be able to get the revised value of the assets as well. Wow. So this is the computation of the impairment loss. And then the allocation of the impairment loss, considering the instructions in the question, considering the goodwill that was second priority, and then the other assets in the CGU. And when you decrease the other assets in the CGU, you need to be careful. Leave those assets which you have already taken care of. In this case, the goodwills, patents, machines are done. So the only item left over is the computer and the building, which is going to be written off in the book value ratio. Wow. This is one agenda. Now let's, I think, do something greater, something better in this case. Okay, now I think let's get on to something interesting. Wow. Let me crop this a bit. Now, this is a wonderful question. I hope it is visible. And there is another part to the question. This is in any case going to be visible. Just let me know, friends, if this portion is visible to you. Not visible. Okay, I'll just maybe change this. Okay, I think I'm getting a question. So suppose as per the instruction 650 entirely goes to machine and building, then there is no need to allocate the goodwill. Am I correct? Technically, yes. Technically, yes. Because you see, if there has been a damage which is given to a certain specific asset, we'll go with the instructions of the question. So just in case, let's say as per the instructions, the impairment loss gets fully allocated, then technically I will not be touching the goodwill. That technically is correct. Okay, let me just, I think, zoom this further. Let me just cut this across. Uh, okay, see, is this visible now, friends? Okay, so this is going to be visible. Let me just cut this across. Okay, see, is this visible now, friends? 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 Okay, see, is this visible now Can you see this? Otherwise, I'll share it on the screen maybe. Is that visible? Otherwise, I'll probably share it through the laptop. Not that. Okay, no issue. I'll just share the question on the laptop screen in that case. Just give me a minute. Okay, I think I'll just read the question by sharing the screen out here. You can just have a look. I think now it should be visible. Practical life is impairment, goodwill first. In fact, yes, that's right. That's what the standard actually states. But technically, when you're looking in terms of the instructions in the question, they're always supreme. Okay, so let me just slightly zoom it further. Okay, now we're just going to read the question from here. So let me just read this. This is one of the questions which came in RTP. This is RTP 2019. Let's just read the question across. I'll open the question in front of me as well later for later computations. It's a very interesting, good question indeed. It says Area Limited is a manufacturing company which deals in manufacturing cold drinks and beverages. It is having various plants across India. Then he says there is a machinery A in the Baroda plant which is used for bottling. There is one more machine which is machine B which is clubbed with machinery A. So are we doing impairment testing for a CGU or are we doing it for individual assets? Of course, CGU, because they say you've got a machine A and you've got a machine B, and both the machines are clubbed together for the purpose of impairment testing. Machinery A can individually have an output and also sold independently in the open market. Machinery B cannot be sold in isolation, and without clubbing with machine A, it cannot produce output as well. The company considers the group of assets as a CGU, and there is an inventory of 2 lakhs and there is a goodwill of 1.5 lakhs in the CGU. So we can say that there are 4 assets in the CGU in this particular case. One is, you can say that there is a machine A, one is there is a machine B, one is there is inventory, and one is a goodwill. Now let me tell you, as far as inventory is concerned, if you remember in the step number 1 of the scope, ICAI clearly said that inventory is got an inbuilt impairment. So in any case, when it comes to the allocation of impairment loss, we are not going to touch inventory because inventory will be captured in accordance with Ind AS 2, and Ind AS 36 would not apply in this case. Then he says machinery A was purchased on 1st April X3 for 10 lakh rupee and the residual value is supposed to be 50,000. Machinery B, which is purchased on 1st April X5 for 5 lakh rupees with no residual value. And the useful life of both the machines is 10 years. So we're given the cost of the machine, we're given the scrap value of the machine, and the life is given. The company expects the following cash flows in the next 5 years pertaining to machinery A. The incremental borrowing rate is supposed to be 10%. So these are the cash flows for machinery A. I can easily calculate a VIU for a machinery A. Then he says on 31st March X8, it's 5 years since machinery A was purchased and it's 3 years since machinery B was purchased. So it says on 31st March X8, the professional valuers estimated that the current value of the machinery A is 7 lakh. And then it says the valuation fees is 1 lakh. There is a need to dismantle the machinery before delivering it to the buyer. The dismantling cost is 1.5 lakh and the specialized packing cost is 25,000 and the legal fees is 75. Would you like to tell me that what is the fair value less the cost to sell as far as machine A is concerned? When he says the valuers have taken the current value to be 7 lakh, they've taken a valuation fees which is to the extent of 1 lakh. Then he says there is a need to dismantle the machine and the dismantling cost is given. The specialized packaging cost is given. So would you like to give me what is the value in use for this machine? Are you going to reduce everything? That is the valuation fee and the dismantling and the packing cost. Let's see what is the answer we got. So I am given it is supposed to be 3.5. No, I'm afraid it's not going to be 3.5. You will take 7 lakh rupee. I am not going to reduce the valuation fee. That is what the valuer charged me to calculate the value. That's not the cost to sell. So we're going to reduce the dismantling cost of 1,50,000 undoubtedly. We're going to reduce the special cost, that is 25,000, and the legal fee 75. It works out at 4,50,000. The valuation fees will not be reduced because that is the amount which the valuer has taken for the valuation purpose. Then he says the inventory is valued in accordance with Ind AS 2. The recoverable amount of CGU is 10 lakhs on March X8. And then it says in the next year, the company has done the assessment of recoverability of the CGU and found that the value of CGU is 11 lakhs on March X9. So there are two parts to the question. One is on March X8 when you're calculating the impairment, and then there seems to be a reversal in March X9. The recoverable amount of the machine A is given and the combined value of A and B on March X9 is given. Now let's see the requirement of the question. Compute the impairment loss on the CGU and the carrying value of each asset. It says calculate the impairment loss for the CGU as a whole and the carrying value of each asset after the impairment loss for the year ending March X8 by providing the relevant working notes to arrive at the calculation. Then it says compute the prospective depreciation for the year X8, X9 on the above assets, because once you've taken the impairment, then the depreciation is taken on a prospective basis. And then it says compute the carrying value of the CGU. It says on March X9. I think if you just want to have a quick look at the details, just quickly have a look on the inputs. I'll just quickly make a walkthrough, then we'll solve. So very good question indeed. I think that's a wonderful question which came in the RTPs. So without valuation fees, how is it fine to take it? You see, valuation fees is what the valuer is charging you to value the asset. It's not a cost to sell. It's not a cost to sell. You can, go for, something which is available in the market price. You cannot say it's a cost which is necessary to make a sale of the asset. You need not have gone for a valuation. The cost which is necessary to make a sale is something, you have to dismantle it. You need to incur certain costs to dismantle it. That's important. Valuation fees, no. I hope you got the answer that why the valuation fees is not taken, correct? Okay, so quickly, if you look at the facts, the company is organizing the CGU in terms of plant A and B, and along with inventory and goodwill. The date of acquisition of A and B is given, the cash flows of A is given, and the fair value less cost to sell for A is given. We're not given any details for the B. And then it gives us the recoverable amount at the end of each of these years. Okay, I think I'm now stop sharing the screen and let's go ahead. So just value it. It's not needed. That's right. Sometime we will not sell. Just know about, hence the valuation would not be taken. Yes. You see, you are just trying to be on the safe side, trying to calculate the value which you can derive on the sale of the asset. It's not something which is necessary to make a sale. I mean, it's only that you're trying to get the broader parameters. Okay, this is the value it can be sold. Correct. Okay, so I think let's take it further. So I guess I'm going to solve this separately out here. So let's have a look at the question number 3. Now, my first question before I solve this particular question with you. Why is he giving you the details of the fair value less cost to sell for A? Why is he giving you the cash flows for the machine A? Why is it required? If you're doing the impairment testing for the CGU, am I not going to simply add up? Am I not simply going to add up the values of machine AB, inventory and goodwill, compare it with the recoverable amount and get the impairment loss? Why is he giving you the status in terms of the cash flows of machine A or in terms of fair value less cost to sell? That is the agenda. to find out the recoverable amount. But why do you need a recoverable amount for machine A? If you're doing an impairment testing for the CGU as a whole, you need a recoverable amount for the CGU. Why do you need a recoverable amount for machine A? That's what my question is. This question clearly says that we're not doing impairment testing for machine A or B standalone. We are considering it as a part of the CGU, A, B, inventory, and the goodwill. Then what is the good need of calculating all this? I'll tell you. Can I say in this particular case, when you allocate the impairment loss to machine A or B, can I say you cannot allocate an impairment loss more than, let's say if machine A can recover an X amount, you cannot reduce it below that X amount, right? So the idea of calculating the recoverable amount to machine A is that once you allocate the impairment losses to machine A, you don't land up allocating more than the losses which should be allocated. Because if you know that machine A has got a certain recoverable amount, the allocation of impairment loss should not reduce the machine below that recoverable amount, right? Okay, so I think let's proceed with the input. So I think let's do one thing. I think let's first make a working note. Let's first make a working note and organize a few inputs in this case. So I think the first working note I'm doing is let's organize the book value of machine A and B, and then let's organize the recoverable amount of machine A so that we know that how much impairment loss can be allocated to that machine. So let's first organize the book value. Let's organize the book value of machine A as well as machine B. So let's calculate the book value of machine A and B. So first let's calculate what was the date of purchase. So that we know how many years of depreciation is to be taken. So I think the date of purchase of this machine, I'm just keeping the question in front of me. So the machine A, I guess, was purchased on 1st April 13. It was purchased on 1st April X3, and the machine B in this particular case was purchased, I guess, on 1st April X5. This was purchased on 1st April X5, and we are trying to calculate the book value of the machine, I guess, on 31st March X8. So let's, I think, calculate the depreciation. So let's consider what is the depreciation for machine A. So if I take the depreciation machine A, the cost of machine A is 10 lakhs and the scrap value is 50,000. So 10 lakh minus 50,000 and the life is 10 years. Let's see what is the depreciation per annum. I think it's 95,000. And similarly, we can consider the value of B machine. The value of B machine, it's given it's 5 lakh with no scrap value. So this has got no scrap value with a life of 10 years. And this will give us a depreciation 50,000. So I think with this, we will be able to calculate a book value, which is on 31st March X8. So how many years of depreciation for the asset A? X3 to X8, that means 4, 5, 6, 7, 8, 5 years. So can I say this will be 10 lakhs minus 95,000 depreciation for 5 years. So let's see what is the book value of the asset. That's right. 95, 5 years depreciation. I think it comes to 5 lakh 25. And as far as B machine is concerned, it's going to be depreciated for how many years? That is purchased on X5, so 6, 7, 8, 3 years. And that works out, I guess, at 3 lakh 50. So this is the book value of the machine A and B, which stands computed. Okay, now once we've organized this information, now it's time to get the second working note. Let's organize the recoverable amount of machine A. So we will now calculate the recoverable amount of machine A. So in this particular case, we need the higher of the two. So we need the higher of the two. One is the fair value less the cost of disposal or cost to sell, and one is the VIU. So in terms of the value in use, we need to consider the discounting of the cash flows. So let's, I think, consider the discounting of the cash flows in this case. So we've got the year number 1, 2, 3, 4, 5. And I guess the cash flows are 1.5 lakhs. Then this is 1 lakh. And this is 1 lakh and 150. And fifth year, the cash flows are given to me. It's 1 lakh. But it says it is excluding the residual value. So you can add the residual value also. Because when you're considering the value in use, we need to consider the cash flows, including the terminal or the scrap value as well. And the discounting rate is at the rate of 10%. So 909, 826, 751, 683, and 621. Let's see what is the present value of all this. Some clerical calculations. Why not for machine A? Well, sorry, machine B. Machine B, I don't have the data, na? Machine B, I don't have any data. I'm only given the data as far as machine A is concerned. So this calculations can be done for machine A only because B is not saleable is not producing cash flows independently. We can't do that. So I think let's calculate this. This is 1,50,000 into 0.909, 136,350. 136,350. Then this is 157,700. Then this is going to be 0.621683. This is 195,600. So I think the sum total of this is 489,650. The sum total of this is 489,650. This is the total. I've just shown the workings out here. So this is the present value of all the cash flows put together, and then the fair value less cost to sell. So we know that machine A can be sold at, it says, to the extent of 7 lakh rupee. Then there is a cost to sell. We won't take the valuation fees, but we have got a dismantling cost of 1.5 lakhs. And we've got a special fee, packing cost of 25 and legal fees. So 25,000 and 75,000. This is the fair value less the cost of disposal. So that comes to 4,50,000. So I think we know the recoverable amount is the greater of the two. The VIU 489,650 becomes. So machine A cannot be reduced below this figure. What is important is that machine A cannot be reduced below this particular figure. Okay, now I think let's go on to the calculations of the impairment loss. So now we go on to the main solution. Let's see the computation of impairment loss. The computation of impairment loss, and then we'll do the allocation as well. Then we'll also go for the allocation of impairment loss. So all the calculations which we have done so far is for the reason that we need to allocate the impairment loss so that we do not allocate the loss towards A more than its recoverable amount, because you can recover the machine A, a certain amount can be recovered. So all that working notes we have done is for this purpose. Now let's consider what is the CGU. We've got machine A. Let's organize the book value, machine A and B. So what was the book value machine A? That's, I think, 525. The book value of machine B is 350. Then there is inventory. And then there is goodwill. So let's consider the sum total of this. Inventory, I guess, is given to me. I think it's 2 lakh. Inventory is given to us, it's 2 lakh, and goodwill is supposed to be 1,50,000. So this will give us the carrying amount of the CGU inclusive of the goodwill. So once you take the sum total, we get the carrying amount inclusive of the goodwill. So 525, 350. This comes to 12,25,000. and you compare this with the recoverable amount of the CGU. What was the recoverable amount of CGU? I guess the recoverable amount of CGU is on March X8 was given in the question, I guess, at 10 lakhs. So can I say we get the impairment loss, and that is to the extent of 2,25,000. That is the impairment loss. Wow. Now this 2,25,000 is to be allocated. So what are you going to do now? Are any instructions given in the question? No. So am I going to first decrease the goodwill? Yes. Then you're going to decrease machine A, and then you're going to decrease machine B. So in this case, this 2,25,000. So let's see the allocation of this impairment loss. So we will first decrease the goodwill. The goodwill is reduced to the extent of 1,50,000. Then we'll decide that we need to allocate the impairment loss to machine A. I cannot decrease. First I can say, okay, let me allocate the remaining loss towards A and B in the ratio book value. Ideally speaking, out of this 225, we should divide the remaining towards machine A and B in the ratio of book value. Let's do that. So we'll take the impairment loss that is remaining 75,000 in the book value ratio. But once you divide this in the book value ratio, we need to see that A doesn't get a larger share of impairment loss. The value, the revised value post impairment should not fall below its recoverable amount. Let's first of all calculate the difference. Let's divide this in the book value ratio. So 525, 350, 875. So I think ideally this is 45,000 and this is 30,000. This is allocating this impairment loss in the book value ratio. That's what we have done. So ideally speaking, the impairment losses will be allocated to machine A and B in the book value ratio. But we need to now make a cross check. Now we need to see that if I consider this 45, what will be the revised book value? So can I say this is 525 minus 45? So if you allocate 45,000 loss towards A, you need to see what will be the revised book value of A post the impairment. So 525 minus 45, it comes to 4,80,000. But the problem is, can I allow this machine to go below the recoverable amount of A? What do you say? In the working note, we have already calculated the recoverable amount of A. Will I be able to afford 45,000 allocation to A? Let the revised book value go below the figure which we calculated, 489. The answer is no. I think now you have got the answer. Why did we do these calculations? B, we did not have the data to do any calculations. But A, since you made the calculations, the revised book value cannot go below this figure. So we have to keep A. So it cannot go below. It cannot go below 489,650 in any case. So how much impairment loss will get allocated to A? How much impairment loss will get allocated to A? Can I say you can bring it to 489,650? So 525 is the book value today minus 489,650. You can allocate only 35,350 towards A. I hope you got the picture. Correct. So this 35,350 will be allocated towards A. The remaining will be allocated towards B. So out of 75,000, the remaining 39,650 is going to be allocated towards B. I think now you can see it's a wonderful question which came in the RTPs because we were required to ensure that the revised book value of A doesn't fall below a certain limit. On a very idealistic situation, we divide the impairment loss in the book values, but that leads to a larger share going towards A. But since we know that A cannot be reduced below a certain figure, so we need to restrict the impairment loss to that figure. And then the remaining impairment loss is allocated towards B. So I think this is one part of the question done. Thereafter, the depreciation changes and then there is a reversal. I'm not spoken on reversal, so I'm not doing the reversal part at this stage, but I have done with the inputs in terms of computation of the impairment loss. One part of the question, March X8 is done. Then he's asking for depreciation, which is going to be spread over the remaining life. Reversal, we'll talk later. Good one indeed. I think it's time now to give you some break as well, because then after this, we'll discuss some more agendas regarding the concept of corporate assets. That is the next agenda of discussion. Yes, first in the ratio book value. Yes, then check the recoverable amount versus due to loss. Correct. Brilliant question indeed. Right, friends, I think time to give you a break, 10-12 minutes at the max, and then I join you back and start this. Take rest. We'll start back. ब्रेक लगा दीजिए. Welcome back, friends. I hope you had a relaxation of mind. Now, some more technical issues coming in. I think we now need to discuss goodwill as well. I think let's do one question on the concept of grossing up the goodwill as well, because I think that's one area where the allocation of impairment loss takes a very interesting turn. So we are still on the step number 3 to remind you, where we're looking at the issue number 3, that is the impairment of a CGU inclusive of the goodwill. Then we'll come to the corporate assets after that. Let's, I think, first do another question with you. Maybe a better question indeed. Yes, I think that combines the aspect of Ind AS 103 and the aspect of 36 both into account. So let's have a look at this. I think this should be visibly clear, I guess. Okay, so let's have a look at the question number 6. It says on January X5, Lucky purchased 80% shares of Happy for 5 lakh, and the fair value of the net assets is given on the acquisition date, and the carrying amount of the net assets excluding the goodwill is also given. And Happy is a CGU. On December X5, that is on the balance sheet date, the recoverable amount of the net assets is given. Now we require to calculate the impact of the impairment review if the NCI is taken at a fair value and if the NCI is taken at a share in the fair value of the net assets, that is PASNA. So simple, straightforward. So we are required to do two things. I think in this particular case, you can notice that even goodwill is not given. So I think what you need to do at the first instance is deal this question in two parts. You need to calculate the goodwill as per Ind AS 103, that's one. And then you need to calculate the impairment loss as per Ind AS 36(2). There have been some similar kind of questions which have come in the exams in the past examination as well on the similar lines. So in this case, we are required to do two things. So let's do one thing. Let's go one by one. So I am first looking at the calculation of the goodwill. So we are first of all looking at the computation of goodwill. This is also 5 lakhs. So this is both to the extent of 5 lakhs. What? The board is not visible, is it? Am I
Sir, are we
visible, friends,
audible?
to you? It's visible. Okay,
Sir?
okay. I hope you could see where I started off. I think the electricity just went off. Somebody saying it's not visible. Let me just, I think, only audible. Now, please see if this is visible. Can you see the board now? Not visible. Okay, just give me a minute, please. No, even I can't hear you. Is the board visible now, or should I log in again? I think. Okay, I'll just log in again.
Students, just wait for a few minutes. Sir will restart the system.
हाँ जी, मेरी बात आ रही है? Okay, okay. Audible as well as guys. Okay.
सर ये क्वेश्चन आप शुरू से करा दीजिएगा जब आप
हाँ
ब्रेक
जी,
जाए।
हाँ जी,
यस सर।
हाँ जी. Yeah. Sorry, friends. I think there was some electricity issue. The electricity just went off for a minute. And bad question, I think. I don't worry. I'll just repeat the inputs again. Please don't worry on that. I'm just putting the question once again. So we were doing the question number 6, where the agenda is to discuss the treatment of, you can say, the goodwill in terms of impairment. when your NCI is taken at a fair value, the goodwill is full, and when the NCI is taken at PASNA, the goodwill is partial. So it's a blend of Ind AS 103 as well as Ind AS 36. Let me just read the facts once again. So it says on 1st January X5, Lucky purchase 80% shares. It says for 5 lakh rupee. The fair value of the net assets on the date of acquisition is given, and the carrying amount of the net assets on December is given, excluding goodwill. And it says Happy is a cash generating unit. The company in entirety is a CGU, and the recoverable amount is given at the end of the year. Now we are required to calculate the impact of impairment review if the NCI is taken at a fair value, 1, and if the NCI is taken at the share in the net assets, that is PASNA, number 2. So in this particular case, there are two aspects. First, you need to calculate a goodwill, and then you need to calculate the impairment loss. So there are two different exercises. One is the calculation of the impairment loss, and one is the goodwill calculation. Goodwill is purely based on Ind AS 103, and the impairment loss is purely based on 36. So we'll go step by step in terms of two elements. So at the first instance, let's calculate the goodwill. So I'm dividing this in two sections. I want to calculate the goodwill. So there is a goodwill computation. And when you're looking at the goodwill computation, the focus is on Ind AS 103. The focus is on Ind AS 103. So where we are considering the NCI at a fair value, and we are considering the NCI at a PASNA. So first of all, your focus would be to calculate the goodwill completely on 103. So you know how the goodwill is taken. You take the purchase consideration and you add the NCI, take the sum total, compare this with the net assets, and you're going to get the goodwill figure in this case. So let's first organize the data and calculate the goodwill before we proceed further. So I think let's come back on the question to see the inputs on the purchase consideration. On the very first line, it says Lucky purchase 80% shares for 5 lakh. So the purchase consideration, of course, remains at 5 lakhs in both the cases, no difference. And then if I come to the NCI in the requirement of the question, so we given the fair value is 1 lakh 30. So fair value is supposed to be 1.3 lakh, and net assets is also given in the question. The fair value of the net assets on the date of acquisition is 5 lakh 90. So here we can also take the net assets at 5.9. And when you take the NCI is taken at a fair value, sorry, PASNA, so 20% of the net assets. So net assets is 5 lakh 90 into 20% would mean 1.18 lakhs. So this comes to 6.3 lakhs. So goodwill is supposed to be 40,000. And this is going to be 6.18 lakhs. And the goodwill is supposed to be 28,000. And I think needless to mention, but I think I'll still make a mention and you can vouch me. Can I see if I took the NCI at a fair value, it's a full goodwill. And if I took the NCI at a PASNA, it is supposed to be a partial goodwill. And we need to be careful when we do the impairment testing, because in terms of partial goodwill, you need to do a grossing up as well. So in this particular case, we can say this is full goodwill. And this is supposed to be a partial goodwill. Now let's see the impact of this in terms of Ind AS 36. I hope friends, so far so good. Nothing technical so far. We've just taken the inputs in terms of the goodwill calculations. No 36, just 103 on the calculation of the goodwill. Exactly what you do in a business combination standard. Okay, so let's go further. Now the next agenda is in terms of calculating the impairment loss. So we need to go in for a computation we need to go in for a computation of impairment loss in this case. And here again, let's divide this in two parts. And here the focus is completely on Index 36. So I think we need to be very careful, when you're working out the impairment part, you need to be careful. Goodwill computation is a different standard. Impairment loss computation is a different standard. So when you're focusing on goodwill, your focus is 103, business combination. When you're focusing on the goodwill impairment loss, your focus is on 36. Now, let's consider if there is a full goodwill, then what? And let's consider if there is a partial goodwill, then what? Now, he is very clearly said that as far as the company Happy is concerned, it is supposed to be a cash generating unit. And for a CGU, when you calculate the impairment loss, you consider carrying amount of the CGU. And to this, you're going to add the goodwill. And once you take the carrying amount and the goodwill, then you need to compare this with the recoverable amount. And that's going to give you an impairment loss. And then you need to decide how the allocation of that impairment loss will also take place. I think it's now time to put some questions to you based on this calculation. So let's go back and see what is the carrying amount of the CGU. So very clearly, I'm given the carrying amount of the CGU is 5,20,000 excluding goodwill. So the carrying amount of the CGU excluding the goodwill is 5,20,000 in both the cases. And then we need to add the goodwill. We've already calculated the goodwill. So goodwill is 40,000 and partial is 28. So this is 40. And what about this 28? Are you going to consider 28 as it is, or are you going to do a grossing up of the 28? Because 28 represents only the parent share of goodwill. So do we consider 28 or do we gross up the goodwill? 28 represents 80% and gross it up. And that's right. So in this particular case, we take this 28,000 and this represents 80% because the parent has got an 80% stake. So 28 grossed up becomes 35. So this is to the extent of 5,60,000 and this is to the extent of 5,55,000. And then you need to compare this with the recoverable amount. Let's go back to the question. And I'm given the recoverable amount is supposed to be 5,30,000. So let's consider the recoverable amount is 5,30,000. So this impairment loss is 30 and this is also 5,30,000. This impairment loss is 25. Now comes the crucial point in terms of allocating the impairment loss, where I see many people at time, go wrong. So please hear me very carefully, because I'm going to give you a very simple trick in terms of deciding how the impairment loss is allocated, especially if you got a partial goodwill when the NCI is a Vipassana. Now watch this carefully. I think if I'm looking at the allocation, I think let's do it in the next slide. When I'm looking at the allocation of impairment loss. So in this case, again, we're looking at two different cases. So we're looking at the impairment loss is 30. The impairment loss is 30. The impairment loss is 25. And now we need to decide the allocation. Now we are not given any instructions in the question. So we're going to first of all decrease the goodwill, and then if the need be, decrease the other assets in the CGU. So in this particular case, if I look at this point, my goodwill is already to the extent of 40. So no challenge. I think since I need to decrease my impairment loss of 30, the entire can be allocated simply towards goodwill. So in the first case, we can allocate this completely towards goodwill. So we will decrease the goodwill to the extent of 30 because the goodwill is to the extent of 40 and therefore the impairment loss less than goodwill entirely allocated towards goodwill. Had the impairment loss exceeded the goodwill, you would have decreased the goodwill by 40 and you would have decreased the other assets in the CGU in the ratio of book value. So it's as simple as that. You need to see that the impairment loss compared to the goodwill figure. If the impairment loss is less than goodwill, only goodwill. If the impairment loss is more than goodwill, first the goodwill and then the other assets in the CGU in the book value ratio. Now, coming to the next one. In this particular case, what do you need to do? In this case, the grossed up goodwill is 35. Now, what do you need to do in this case? You need to compare this impairment loss with the grossed up goodwill itself. I'll give you another area as well. Right now, the impairment loss is 25, which is lesser as compared to the grossed up goodwill. So we can decrease goodwill only. So in this case, we need to decrease the goodwill. But we will decrease the goodwill not by 25, but 80% of 25, and that's to the extent of 20. Because this figure of impairment is after grossing up goodwill. So when you say that you will decrease a goodwill, then in this particular case, we will decrease 80% of this goodwill because only 80% stands reflected in the financial. Now, let's assume that let's say the impairment loss in this case would have been 40. Then I think let's see the interesting part. Now, if the impairment loss is 40, this is exceeding the grossed up goodwill. Now, if this impairment loss is 40, it exceeds the grossed up goodwill. So what are you going to do? See what you're going to do. So I will say I will decrease the goodwill to the extent of 35 and I will decrease the assets. I will decrease the assets to the extent of 5. Get the split. So first we'll decide that out of this 40, what is the amount of goodwill impairment, which is the grossed up figure 35, and the rest is other assets. Take this 80% because only 80% is appearing in the balance sheet, that's 28. And take this as 100% itself because the assets appearing in the balance sheet is 100. This is where the important catch is. That when you consider the NCI at a PASNA, you need to compare the impairment loss vis-a-vis the grossed up goodwill. If the impairment loss is more than the grossed up goodwill, you need to decrease the other assets. Now, when you calculate the goodwill impairment, you take 80% of this, but when you take the other assets, you take 100% of this. This is going to be borne by the parent company. So this goodwill impairment is borne by the holding company only because NCI's goodwill is not appearing in the balance sheet. But this is going to be borne by the holding company and the NCI both in the ratio of 80 and 20%. This is where people at times go wrong. So I'm just going to connect the dots once again to get this absolutely clear. So what do you need to do? I would say that you should compare your impairment loss vis-a-vis the grossed up goodwill. If the impairment loss is less than or it is equal to the goodwill, grossed up goodwill, you can just write off the goodwill 80% done. If your impairment loss is more than the grossed up goodwill, divide how much goodwill decline, how much is the asset decline. Take 80% of the goodwill borne by the parent and take 100% of the assets borne by the parent and the NCI both. I hope, friends, I stand absolutely clear on the concept of goodwill impairment in terms of PASNA and in terms of fair value. So assume under partial goodwill the loss is 30, then what is the treatment? Well, if it is 30, it's not a problem because if this is 30, then the grossed up goodwill is more than that. So you need to take 30 itself into 80%, that's 24. So the main thing is divide the amount of impairment loss between the grossed up goodwill and the other asset. Grossed up goodwill, take the share 80 and the other assets take 100%. You will never ever go wrong. I hope, friends, I'm clear on the agenda. Great. So this was my issue number 3. Now we've got the issue number 4. So within the step number 3, we have done 3 issues: impairment individual or impairment group of assets 1. Individual assets computation accounting done. CGU computation accounting with the goodwill aspect done. Now comes the corporate assets. So I think in the corporate assets, again, I'm carrying a question. I think we'll explain that with an example itself. Maybe we can do a small little question on the aspect of corporate assets. Yes. So I think this might also may not be too much visible indeed. No worries, I'll share this on the laptop to you. So first just have a look if this is visible. Otherwise, I'll share it on the laptop. So is this visible, friends, or should I share this? Session is excellent and clear. All doubts, that's wonderful. Not visible. Okay, not an issue. I'll share this, friends, on the laptop to you. Just a minute. So I'm carrying a question on the corporate assets, and then we'll talk in terms of reversal after this. So let's have a look at the question out here, the question number 10, which is on the screen as well. I think I'll just read the question on the laptop. It says M has got 3 cash generating units, A, B, C. Due to adverse changes in the technological environment, indications of impairment, M conducted impairment tests for each of the CGU. On March 18, the carrying amount of all the 3 CGUs are given. Then he says the operations are conducted from a headquarter that is a corporate asset, and the carrying amount of the corporate asset is given. There are 2 corporate assets, one is a building and one is a research center. Then he says the relative carrying amount of the CGU is a reasonable indication of the proportion of the headquarter building devoted to each of the CGU. So the allocation of the corporate assets will be done in the ratio of the relative carrying amounts. Then he says the carrying amount of the research center cannot be allocated. Now, only one of the corporate assets can be allocated, the other one cannot be. Not a problem. Now, you know this, that if you can allocate any one, you are going to conduct, first of all, what we call a bottom-up test. And then we will consider the larger CGU and we're going to conduct what is called a top-down test. So one impairment testing will be done after considering the allocation of the headquarter building only. The second impairment testing will be done by considering all the assets put together, not only ABC, but the headquarter building as well as the research center. The first test is what we call a bottom-up test, and the second one is what we call the top-down test. Then I'm given the life of the assets. The life of the assets for ABC is 10, 20, 20, and headquarter assets is supposed to be 20. So we need to be careful when we're going to consider the relative carrying amount for allocation. It says the headquarter assets are depreciated on a straight line basis. Then he says the recoverable amount of each CGU is based on the VIU since the net selling price cannot be calculated. Therefore, the value in use for ABC as well as for the company as a whole is given. It says in the asterisk, the research center generates additional future cash flows for the enterprise as a whole. Therefore, the sum of the VIU of each individual CGU is less than the VIU for the business as a whole. He's just trying to caution you that if you're just trying to add the recoverable amount of ABC and it doesn't match with the VIU for the company as a whole, don't get sentimental. Then he says the additional cash flows are not attributed to the headquarter building. Calculate and show the allocation of impairment loss as per Index 36. Ignore any tax effect. So this is RTP 2018. A similar question came in the exams for 10 marks in November 18 as well. Okay, so I think let's do this particular question. We need to conduct 2 tests in this particular case, one by one. So let's, I think, begin. Let me just also open this question so we can do this. Yes. So I think let me just start solving this question with your help. Okay, so I think first of all, let's look at the question number 10. So what we are supposed to do at the first instance is conduct what is called a bottom-up test. That means whichever headquarter assets can be allocated, let's consider that. So let's first of all consider what is the bottom up test, and then we'll conduct the top down test as well. So we've got three cash generating units, that is A, B, and C. So what we're going to do, just like we do in terms of goodwill, we consider the carrying amount of CGU plus the allocated goodwill. Same thing out here. We need to consider the carrying amount of the CGU with an allocation of the corporate assets along with this. So let's take the carrying amount of the CGU. I guess the carrying amount of the CGUs is given to me. It says the carrying amount of ABC is 100. Then this is 150. And this is supposed to be 200 lakhs. So all these figures are in lakhs. And to this we allocate the corporate asset. And the only corporate asset we are considering is the headquarter building. Now, let's get the inputs from your side, friends. Can you tell me what is the ratio in which I will allocate the building between ABC? Consider the life of the asset A is 10 years, the life of B and C is 20. So can I allocate this in the ratio of 10 is to 20 is to 20 or something else? This has got a life of 10, this has got a life of 20, this has got a life of 20. So what do you need to do? Relative carrying amount. So can you tell me what will be the ratio in this case? Am I going to consider the book value or we are going to amend the book value? And if yes, what is the ratio? So we need to divide 100 by 2. That's right. So I think you've got two alternatives just to put it. One way is that you consider this 100 as 50 and keep this as 150 and 200. Or the other one is you keep this 100 same and double this up and double this up. So either ways you can do this, because in this case 150 with a life of 20 is as good as 300 with a life of 10. 200 with a life of 20 is as good as 400 with a life of 10. So you can take any of the ratios, ultimately it is same. So 1 is to 3 is to 4. So let's see what is the headquarter building value. So we given the headquarter building is supposed to be 150 lakhs. Divide this in the ratio of 1 is to 3 is to 4. Let's divide this. So this is going to be 150 divided by 8. I think this is coming approximately, I guess, 19. And this is going to be, I think, 56. And this is, I guess, 75. So this is the allocation of the corporate assets. So we can take the sum total of this and compare this with the recoverable amount to calculate the impairment loss. So we consider the sum total of the carrying amount with the allocated corporate assets compared with the recoverable amount. So this becomes 119, this becomes 206, and this becomes 275. And if you look at the recoverable amounts in this case, the recoverable amount is 199, then it is 164, and it is supposed to be 271. So we can get the impairment loss. This is 4. Here the recoverable amount is greater, and this is supposed to be 42. Now the question what comes into mind is, how would you allocate this impairment loss between the assets within CGU? Are you going to allocate this in the ratio of the book value of the CGU and the building? What do you say? So why not taken the corporate asset research center? Well, it said research center is not allocable. We are not given a reasonable basis on which a research center can be allocated. So it'll become a part of the top-down test later. In this case, we are considering only that corporate assets which can be allocated, right? So is this impairment loss supposed to be divided between both these assets in this ratio? Yes. Is this impairment loss going to be divided between both these assets in the book value ratio? Yes. So I think let's see what is the division of this. 42 divided in this ratio. So 42 into 150 by 206. I think this is coming to approximately 31. And this is coming to approximately 11. This is coming approximately 3. And this is coming approximately, I guess, 1. I guess that's right. So this impairment loss of 42 will be allocated in this ratio between the two assets, and this 4 will be allocated in this ratio between the two assets, the assets of the CGU and the corporate asset. Now it's time to conduct the top-down test. So once we have organized this, now it's time to go for a top-down test. Now, when you're conducting a top-down test, we need to be careful. You need to consider the revised values of ABC. You need to consider the revised value of the building. And you need to consider the book value of the research center. Whatever impairment losses have been identified in terms of the bottom-up test, we're going to consider the revised value. So for ABC, we consider the revised value. For the building, we consider a revised value. And for the research center, we consider the book value and then compare it with the recoverable amount of the larger CGU put together. So let's consider the CGU, ABC, the corporate assets, that is building as well as research center. So let's get the revised values in this particular case. So he said such two assets are compulsory for the corporate asset. Well, I would say there are three kinds of situations if you conceptually look at it. If you can allocate all the corporate assets to the CGU, then we conduct only a bottom-up test done. No top-down test is conducted. If you can allocate all the corporate assets, then only a bottom-up test is conducted done. Then second is if some of the corporate assets can be allocated and some of the corporate assets cannot be allocated, then you need to conduct two tests. One is you need to conduct a test which is a bottom-up test. Whichever asset can be allocated, consider that. And then consider the top-down test where you consider everything collectively. The third situation can be that once you say that none of the corporate assets can be allocated, still you're going to conduct both the tests. You will conduct a bottom-up test without considering a corporate assets, and then you consider a top-down test considering all of them together. So I would say all the permutation combinations, only 3 can be there. If you can allocate all of them, then you consider a bottom-up test only, no top-down test. If you cannot allocate any one of them, you do a bottom-up test without allocation and a top-down test as well. If you say some can be allocated and some cannot be allocated, you do the bottom-up test with those which can be allocated, and then you again do a top-down test with all of them put together. I hope I'm clear on my thoughts, right? You're welcome. Okay, so now let's take the revised values of the asset. So in this particular case, this is 100. It remains at 100. This is 150 minus 31. So this is 100 and this is 150 minus 31. I guess that comes to 119. Then next, this is supposed to be 200 minus 3. The revised values is what we are considering. That comes to 197. Then as far as the building is concerned, careful, building is decreased by 11 plus 1, that is 12. So 150 minus 12. So building is supposed to be 150 minus 12, that's 138. So these are, you can say, the revised value of all the assets post the bottom-up test done. Now, as far as the research center is concerned, you take the book value. The research center is supposed to be 50 lakhs, that is the book value. So these are the revised values. These are all the revised values. And what was not allocated is being considered at a book value. And then you take the sum total of this, compare this with the recoverable amount, and let's get the impairment loss in this case. And once you get the impairment loss in this case, then it gets allocated to everybody. It gets allocated to A, B, C. corporate assets, building, research center, everything. So once you get an impairment loss in the bottom up, top down test, allocate it to every asset within this. So this comes 200 plus 119 plus 197, 138 and 50. This is 604. And if you look at the recoverable amount is appearing at 720. So there is no impairment loss, which is there in the top-down test. Wow. So this is my issue number 4, which I did not give you conceptual theory, but I just directly did a question, but I'm just going to pinpoint that this is my issue number 4. This is my issue number 4, which is dealing with the concept of corporate assets. And that takes care of the step number 3. Step number 3, we have covered 4 agendas to remind you. Number 1, CGU impairment or individual asset 3-step model. Individual asset cost or revaluation model. CGU with the goodwill impact and CGU with the corporate asset impact, all the 4 agendas done. Finally, we come to the step number 4, which is on the reversal of impairment. And here we can do some very simplified computations to make life simple. I'll give you the data. Let's, I think, connect the dots in this case. So I am coming to finally my step number 4. And that is reversal of impairment loss. That is a reversal of impairment loss. Now, there are 2 things to be seen in terms of reversal of an impairment loss. So I'll correct you on both the things. Let's make a mind map on this part. If the need be, we'll take a simple example explaining the concept as well. So if I look at, first of all, a quick mind map on the reversal part, there are 2 things. When does a reversal take place? That is one. And the second is, once the reversal takes place, what is the accounting treatment? So we're going to divide our discussions in 2 elements. So we're going to consider this. And you said, so for bottom-up test question is given compulsory useful life, please clear it. Compulsory useful life, no, you see, the life of the asset was given only for the purpose of getting the relative carrying amount of the asset. So I think if you're thinking that what is the role of that life, that was only to allocate the corporate assets to the 3 CGUs under review. Because the corporate assets has got a life of 20, C has got a life of 20, and B has got a life of 20, but A has got a life of 10. So the role of the useful life is only with reference to decide the allocation of the corporate assets to the CGU under review. Correct? I hope you got the answer on that.
Sir, excuse.
Yeah.
So bottom-up approach, I think corporate asset allocation is only done by useful life of respective assets.
Relative carrying amount.
Carrying on. So useful life is not given in question. So how can allocate corporate asset?
Useful life is
In
given
the,
for the headquarter assets. I'll just share it on the screen. You're given this remaining life in this chart. A is 10, BC and headquarter is 20 years. That is the reason when you allocated the corporate assets, we took half of A, or you can make B and C double.
sir, I understand, but my question is, if
Mhm.
in the question useful life is not given, so
Okay.
how
Okay.
can allocate corporate asset?
Okay.
If
Then
the
you can
ratio
simply do it in the ratio book value. If the useful life
oh,
is not given, then you can simply
oh,
allocate in the book value ratio itself. Then there is an indirect presumption which is going at the back of the mind that, the life of all the assets is common. I just divide it in the book value ratio directly.
okay, sir, clear.
You're welcome. Okay, so now coming to the aspect of reversal, there are 2 things in terms of reversal. One is, when do you reverse? What are the indicators of reversal? And the second is what is the accounting treatment in terms of the reversal. Now, trust me, the indicators for reversal are exactly a U-turn of the indications which you've done in terms of impairment. But out of the list of four, are all the four present or just a few of them? You tell me. When you're considering the indications for reversal, are all the four indicators going to take a U-turn, or is the restriction on the indications of reversal limited? Anyone? No, of course, anyone. But are all the four present? No. That last condition of net assets greater than market capitalization is not there. So in this case, there are only three indications given. The fourth one is not there. So we are given three indications. One is that there is a significant increase in market price. So let's say there is a significant increase in the market value of the asset. So that would mean reversal indication. Second is that the interest rates decrease. And the third condition is that there are favorable changes in the business environment. There are favorable changes in the business environment resulting in good cash flows, resulting in a better cash flow. So there is a positive, a favorable impact in the technological, in the economic, legal, political environment. So that results in incremental increase in cash flow. Now, coming to the accounting, the first thing which we need to keep in mind is goodwill cannot be restated. Goodwill gone is gone. Goodwill cannot be restated. If the impairment loss has been allocated towards goodwill, the goodwill is gone. You cannot increase the goodwill. That's one. Now, the second is, I think let's give you the details in this case. When you're looking at the reversal accounting treatment, I would suggest the easy way of doing this is, I'll give you these steps with which things will become easy. First, you need to calculate what can be the maximum revised book value. So you need to first of all calculate the revised book value. We need to calculate the revised book value. What can be the maximum revised book value? So first you need to focus that, okay, if I go for a reversal, what is the maximum revised book value which can be? And this is supposed to be the lower of the two. This is supposed to be the lower of the two. You got to consider book value, which would have been, you need to consider the book value which would have been had there been no impairment ever, had there been no impairment loss earlier. So first organize the book value, which would have been had there been no impairment ever, and consider the recoverable amount as well. Take the lower of the two, that is the revised book value. So when you go for a reversal, just organize the revised book value, the maximum revised book value which can be. Compare the book value which would have been had there been no impairment earlier and the recoverable amount. Take the lower of the two. Then in this particular case, we'll compare. You can say two things. The book value, which is the existing book value, and you need to compare the value in point one. You need to compare this with the value in point number one, and that will decide the reversal. You compare the book value, which is in the books already, and compare it with the value in point one, and then this will decide the amount of reversal. Because reversal will be restricted to the maximum of this. So let's say the book value is supposed to be 2 lakhs, and the value in point number one is, let's say, 2.4 lakh. So the reversal in this case can be to the extent of 40,000 in this particular case. Because we cannot bring the value of the asset more than what is there in point number one. So if the value in point number one is even below 2 lakhs, no reversal can occur. It is only if the value in point number 21 comes more than 2 lakhs, then you decide the amount of reversal. Right, friends. So this is the mind mapping on the reversal. I think let's take a simple little example to illustrate this point of reversal as well. I'll take a small illustration and then we can close impairment. Let's take a simple example on a time scale. So I'm going to give you a simple example. You help me out. Let's take a case of a building, an individual asset, which is, let's say, bought at a cost of 20 lakhs. So let's consider a simple case of a building which is bought, let's say, at 20 lakh rupees. We'll just make a walkthrough. So this building is purchased at time 0 with a useful life, let's say 10 years. Can you tell me what will be the book value after 4 years? So can you tell me what will be the book value of this asset after a period of 4 years is done? Then accordingly, we'll do the calculations in this. And that's right, it is 12 lakh. So we can say the cost of the asset is 20. The depreciation is 2 lakh for a period of 4 years. So this works out at 12 lakh. Now let's consider there were indications of impairment on this date and we conducted an impairment calculation. So let's say in this particular case, we made a calculation of the recoverable amount that works out at 9 lakhs. So we get an impairment loss to the extent of 3 lakhs in this case. Will the depreciation change after this? So will there be a change in terms of depreciation post this? Yes. So can I say I am going to spread over my depreciation on 9 lakhs over the remaining life of 6 years? Because out of 10 years, 4 years have already elapsed. So we can say the remaining life of the asset is 6 years. So spread this amount over the remaining life and we get a depreciation 1.5 lakhs. Okay, let's now consider the status of the book value. And let's say this is after 6 years are over. So let's see what is the book value after 6 years are over. So can I say you would have taken a depreciation 1.5 lakhs for the next 2 years to come. So let's see what is the book value. So this is going to be 9 lakhs minus a depreciation 1.5 for the next 2 years. And I think this works out at 6 lakhs is the book value. That is after a period of 6 years. Now let's give you a data. Now let's say there are indications of reversal of impairment and let's see. So let's first of all consider the recoverable amount. Let's say I give you the recoverable amount is 7.5 lakhs. Can you tell me what is the book value which would have been had there been no impairment ever? Had there been no impairment, what would have been the book value in this case? Can I say the asset was bought for 20 lakhs with a depreciation of 2 lakhs for a period of 6 years? The book value in this case would have been 8 lakhs, correct? That's right. So we are going to consider the revised book value is going to be the lower of the two. So can I say this is the revised book value? So after the impairment, the revised book value cannot exceed more than 7.5. So would you like to tell me what is the reversal of impairment loss? And that's right. So we compare the 6 and 1.5. So we know the reversal of impairment loss in this case is 1.5 lakhs. And I think it's worth making a mention out here. The accounting treatment of the reversal is if it is a cost model, it goes as a credit in the P&L. And if it is a case of a revaluation model, then it will be treated as a subsequent upward revaluation. That means I will credit the P&L to the extent of earlier debit, and if there is a difference, that will be taken in the other comprehensive income. Impairment is a subsequent devaluation like Ind AS 16, and reversal of impairment loss is like a subsequent upward revaluation under Ind AS 16. Right, friends. So I think that takes care of my step number 4 as well. So I think all the 4 inputs in terms of impairment testing done. So I've just connected to the dots regarding the scope. We've also connected the dots in terms of indications. Then the main crucial step 3, in which we covered 4 agendas. How do you decide impairment is individual or group CGU? What is the treatment for individual asset? What is the treatment of CGU with a goodwill? And what is the treatment of a CGU with a corporate asset? And then finally, the reversal of the impairment loss. I think that takes care of the standard, friends. Over to you for any questions on your side. Okay, I think I've got some question. Sir, standard states that if you're considering the asset which is capable of impairment testing independently in the CGU, then impairment loss allocated to such asset should not exceed the asset's individual impairment loss. But sir, I've always been seen that we allocate exactly same impairment loss to such asset even due to CGU if impairment loss pertains to the such asset is lower. Further, if the same only is allocated, then we can just consider the revised carrying amount of the asset for the CGU. I think you might have missed the question which we did today, which was pertaining to that RTP 2019, if you remember, where there was a machine A and B. And in this particular case, we were doing the impairment testing for the CGU as a whole. But if you recall, we restricted the impairment loss of machine A to the extent that it does not get below its recoverable amount. So I think what you're saying, I don't agree with that, because whenever we are doing an impairment testing under Ind AS 36, we need to ensure that post impairment, whatever is the revised value, it should not fall below its recoverable amount. So in any case, if a larger impairment loss is getting allocated to that particular asset, we restrict the impairment loss and the remaining impairment loss is shifted to the other assets in the CGU. I think the 2019 question was a perfect example. I think maybe you joined a little late, maybe Krishnakant. I think therefore you might have missed it, but do watch this. We did that question in 2019 RTP. It's a wonderful question, which I think illustrates the point which you have asked. Yes, sir, but the lower can be considered. Yes, you can mathematically say that. So if you're saying that the allocation decided, or you can say, considering the recoverable amount, whichever is lower gets allocated, mathematically, I agree with that. Yes, I agree. Reversal of the impairment loss for CGU, is there any question? Not that I've seen, I think in the study material, I think which talks about this, but the parameters remain the same. In any case, if you're considering a reversal of a CGU as well, so what you need to do once you get the impairment loss, you cannot restate the goodwill. So you need to increase the other assets in the ratio of the book values itself on a mathematical level, but at the same time ensuring that you do not take them more than the recoverable amount. So it would be something, reverse of RTP 2019, where once you allocate the reversal of impairment loss, you need to ensure that none of the asset goes above the value. That means it doesn't exceed the recoverable amount of those assets. But the procedure, of course, remains the same. You're most welcome. Good morning, ma'am.
Good morning, sir. You're over, then I'll just take 1 minute to address students. I'm finding few more students this time who have joined this LVRC session. So students, I hope you are there in our WhatsApp group also. And in case you're not in the WhatsApp group, we are just giving the link on the chat box. Just you can connect to do that. Ashokji, Ashokji, please give the link on the chat box of that WhatsApp group. And in case students, you have any query regarding any of the topic, you just let us know. You can mail us at bos@ici.in, or you can also give it on WhatsApp. We'll try to address it. And one more thing, students, because these are revisionary classes and we have scheduled only 19 classes, we are trying to cover as much of standards as possible, but still there are few standards which we have not covered in LVRC session. One of the demand was for Ind AS 24 that we are going to consider, but we'll be scheduling it not on Wednesday and Friday. We'll take some class in between, maybe of AFM wala schedule. We'll take it for Ind AS 24 and we'll schedule it in next week. Besides that, in case you have any other standards which you want to cover in your LVRC, just let us know. We'll try to include that also. Students, you can unmute yourself and let us know. Okay, so it appears students do not have any other query. So we can wind up the session. Okay.
Right.
Thank you, sir. Thank you. Thank you, everyone.
Thank you, ma'am.
Thank you, sir.
Thank you very much, friends. So take care. Bye-bye. See you.
Bye, sir.
Thank
Bye,
you, ma'am.
students.